2017. We are a slightly unusual NBFC in the sense that we don't deal with the segments that you typically hear about, and which is why I spent some time on not just the numbers but the business model, so that everybody is clear about where we stand. But first, numbers. We are a 6-year-old company. We are audited by KPMG. We have a gross asset book of 5,850 crores or thereabouts, with a net worth of a little over 1,500 crores, gearing of 3 times, capital adequacy beyond 25%, a credit rating of A from 2 rating agencies, ICRA and CARE, and well capitalized as well as levered by a very large number of lenders as well as HNI investors. Today, Vivriti, in addition to the institutional lenders and investors that you see on the screen, we also have more than 1,700 HNIs who have subscribed to our bonds through the private placement route in the past. Pertinent to note, as many of you would know who track NBFCs, that RBI mandates a minimum capital adequacy of 15%, which can be done through a combination of equity and subordinated debt. Happy to let you know that we are well over 25%, which makes the company much safer, and that number is almost entirely tier 1 capital, which is pure equity. What does our group look like? The parent company is Vivriti Capital Limited, which is also the issuer for the NCDs that we will talk about soon. We have a subsidiary called Vivriti Asset Management, which is a fund manager for alternate investment funds. And finally, we have an associate company called Credit Avenue Private Limited, also based out of Chennai, which is a digital marketplace for debt. We finance corporates, right? We focus on corporates that are cutting across a wide array of businesses, ranging from shipping, mining, engineering, pharma, healthcare, trading, retail, apparel, processing, FMCG, financial services, infrastructure, road development, port development, civil works, electricals. These are the kind of companies that we lend to. These companies are typically companies with anywhere between 100 crores to nearly 3,000 crores of revenue, right? As you can see, a retail lender lends in lakhs. Our average ticket size is 3.5 crores. That itself should give you a sense of the segment that we are operating at. Now, when we lend to these companies, we typically lend to them using term loans, but we also provide to them a wider array of products, right? Because our customer is a complex animal. They want a lot more by way of services and products that can cater to their specific needs. And therefore, we must be flexible from a product perspective. So we have over time launched more and more products. We launched term loans, we launched working capital, we launched vendor finance, dealer finance, securitization, co-lending, NCDs, commercial paper, recently leasing, recently factoring. These are all products that we have launched over the last 5 years to continue to cater to a wide array of needs that our customers require, right? Our ticket size is an average of 3.5 crores. There is a wide range, and our tenure of lending typically is in the range of 2 years, does not go beyond 4 years, but we are here to be a term loan provider to the mid-corporate space. This is the nature of our business. The book has grown from 1,900 to 5,800, which is roughly 3x. But the profitability in the same period went from 30 to 129, which is more than 4x. Which gives you a sense that our profits are now building rapidly as our business is scaling up. This also shows up in the return on asset, gone up from 2.3 to 3, and return on equity, which went up from 4.1 to 8.9 over the same period. Investing in brand development and outreach is very important for a company at our stage. We have done a lot of work in strengthening governance and leadership within the board. This will represent a significant opportunity of diversification for the company in terms of where we raise debt capital from, as well as allow us to improve our cost of funds over time. This is also a segment that has supported NBFCs like ours, much larger NBFCs like ours throughout the last decades. And with bond markets opening up for A-rated companies, we think it's a good opportunity. We have also made the issue very friendly, right? Since we are a first-time retail debenture issuer. We have not tried to make it a very long tenor so that people are able to see their money come back faster. So only 18 months and 24 months. And within that also we have given plenty of options: monthly coupon, annual coupon, quarterly principal redemption. Multiple options have been given to make the issue very, very flexible for our investors, right? And we hope that this will be a success. The issue launches on 18th of August. As Samir mentioned, we have an option to close early if we see subscriptions, and hence it's on a first come first serve basis. But the issue will otherwise remain open till 31st of August. Right?